Canadian inflation dropped the highest amount in 6 months earlier this week, and this comes at a time where we're still at multi-decade highs, with a large portion of Canadians now having to dip into savings and credit to be able to afford current interest rates. What's going to happen next week with Tiff Macklem's announcement with a potential another interest rate hike? We get into that, plus what OSFI is thinking about with new mortgage and credit tightening rules in this episode. Stick around for everything because we saved our predictions for what is coming up next at the end.
Hey guys, this is Ryan Dash here along with my co-host Dan Wertel, and we are with eXp Realty, and every week we create videos like this to keep you up to speed and give you all of the education you need on the crazy Vancouver real estate market. If you'd like to get in touch with us and learn about your home specifically, please reach out in the Calendly link below, book a time, and Dan and I will have that consultation with you. Guys, one last thing, hit the subscribe, ring that bell button so you don't miss any of the news in the Vancouver real estate market and keep your finger on the pulse.
Perfect. So as mentioned right off the top, Canadian inflation print just lowered, and this comes on the heels of the American inflation print, which just came in at 6.5%. They also saw the largest drop in 6 months, falling by 0.6%. Understandably, Canadian and U.S. economies are very tied, as is their inflation. So we are now back to February-March 2022 numbers. We're at a 10-month low in inflation here. What's interesting, if we flash back to that time, if we look back to February-March of last year, when inflation was, between 5.7 and I think 6.5, they had just thought about starting to raise rates then. Okay, they were at 0.25 back in March, and then they raised them a quarter point to 0.5. And now fast forward to today, we're sitting at 4.25 with all bets placed on about another quarter rate hike happening at the announcement, which is next Wednesday, January the 25th. And this is, of course, happening at a time when a lot of Canadians are already stressed when it comes to the payments of their mortgages, obviously for variable rate mortgages, and businesses are being absolutely squeezed to the limit because a lot of their borrowing rates have also gone up 400 basis points, and they're struggling to survive. We're hearing about job cuts all over the place. So the Bank of Canada was obviously late to start the hikes, and now they seem to be hiking into a very downward inflationary environment. So are they over increasing and, of course, putting us at risk of another hard landing? Central banks have a very poor history, if you will, about trying to achieve a soft landing when having to increase rates at a similar rate through a downward market. So what's happening now? The Bank of Canada, of course, has aggressively raised rates, as we know, over the past year to fight this multi-decade high inflation. So understandably, that results in fears mounting that the tighter monetary policy is going to push the Canadian economy into a recession. Some believe we're already here. The job markets may say otherwise. Take your pick onto how you calculate a recession and decide based on that. Either way, as mentioned, following tightening cycles, central banks, outside of even just Canada's, they've got a hard time achieving what they call that soft landing. And a soft landing means basically, you get inflation down to 2-3% and there's no recession. Understandably, that's a very challenging thing to do. So amid high inflation, central banks often struggle to what they call thread the needle, of raising rates to bring it down to 2% without going into a recession and without causing a lot of financial stress and pain, which, like we just discussed, we're already hearing. And if you check out last week's episode, we ran through essentially a consensus of what people are feeling right now and how many are feeling ultra stressed, especially within their financial position within mortgages. But a couple key notes here to point out. Historically, home sales tend to lead the business cycle here. They start to decline many, many months prior to a recession. And by the time a recession begins, if it does, sales are typically near their absolute low point. Well, let's look at that, because it was right around February, March, when we felt the real estate market locally here start to slow down after about an 18-month mega bull run that saw record-breaking year-over-year sales and prices. And then right around February, March, we felt that difference. Anecdotally, we could tell that, hey, when you had 12 months of 5 to 12 offers on every property being the average, and suddenly that dropped off to 1 or 2, you know things are changing. And it was at that point, of course, when the government stepped in and started raising rates to slow things further. And again, like, it was 2 years of record high sales volume. So it's not like they didn't have the data to know that things were ripping out of control.
Yeah.
Now, historically, home sales tend to post substantial recoveries following a recession, as interest rates and other stimulus are created to help support the economy. So here we are at a time when we are at incredibly low sales volumes. In fact, January, we're on track in GVRD here to have the second lowest sales volumes for a January ever, only being trumped by the global financial crisis in January 2008. So what does this mean? It means that we know that the people want to buy right now. You know, it's not even the interest rates that are holding people back per se, because it's inventory. And we know this, right? We run a team of 6, and every one of our team members says their buyers are all repeating the same story. We go shopping, we go on tours, we don't like anything. And it's not about price point, it's about what's available at that price point. So, we're still at 7,600 listings today. Again, I think Ryan had mentioned this in an earlier cast. We're emulating the sales volumes of 2008, but then in 2008, the listings were upwards of, I believe, 19 to 20,000. Right. We're sitting here at essentially a third of that. So a very different and dynamic market. And the thing is, too, we also have very strong economic fundamentals here to support the housing sector, especially in British Columbia. So we're seeing pent-up demand. And sure, love or absolutely hate that term, doesn't matter. The realities are it is palpable. You can tell what is about to happen here. And we know because the construction industry is also hurting so much right now, and all the layoffs there, people aren't building to the need that we are seeing here, especially again in BC. And real quickly here, I'm just going to wrap up this segment on the 5-year Canadian bond, because that, of course, dictates where you're going to see the interest rates go. The 5-year bond is now down 100 basis points since it peaked back in October of last year. Okay, it's now sitting at 2.84%. It was upwards of 3.85 back in October, which was a very short 3 months ago. Year to date, in the last 19 days, we're recording this on Thursday, January the 19th, year to date bond is down 60 basis points. It is dropping hard. So banks are going to start to be able to deepen their discounts when it comes to their mortgages. So what's happening next week? Again, the markets are pricing in 25 basis points from Tiff in his announcement. Could we be surprised? Of course. We don't know. We don't know. Nobody knows. And this is why the placing bets on it. Could it be 0.5? Could it be 0? Either one of those, I think, would have pretty dramatic implications either way in the marketplace. But that is my piece on what is going to happen here with inflation and interest rates next week.
It's pretty interesting, Dan. And before we carry on, it brought a couple questions to my mind. Primarily, we're looking at, I guess the banks are trying to get or the Bank of Canada, central banks by that matter, are trying to get a soft landing, which is extremely hard to do when you've just taken a sledgehammer to the marketplace. And so I think, it's not like they started this surgical precision, a year ago. That didn't happen, right? They just pulled out the sledgehammer and started hacking away and cut this thing down. So I don't really know if they're going to be able to, get that soft landing the way they hope. We'll see, though. We'll see how the media portrays it, too, because that's going to be very interesting. The other thing that kind of comes to my mind when we talk about, your piece there, I know that the Bank of Canada has this target of 2 to 3% inflation, but how do we get back down there when we increase the money supply by 30%? We've gone through a significant expansion in terms of monetary expansion, and reining that back in completely, I think, is going to be very difficult to do, especially over the next little while. I think it will see inflation come down compellingly until we get about 3.5%, 4%, and then I think it gets really difficult. But again, I think we'll see how that plays out, and I think a lot of that has to do with interest rates and what TIF does here in the next little bit. So, Dan, what's your prediction for TIF?
I'm going with the markets. I'm going with the quarter point.
Yeah, me too. I think so too. I think going beyond that wouldn't make much sense right now with the latest inflation print. However,
right? Because the people who are having financial issues are getting louder. And I've been talking about this for months, but again, they love to say they don't bend to public pressure, but they have to consider it. And again, based on our episode last week, I mean, when was the last time you heard that 1 in 4 homeowners with a mortgage were feeling that if rates were to go much higher, they would be forced to sell?
Yeah. Well, who's that going to...
How realistic that is for their individual situations, obviously hard to say. This is more of a sentiment claim, but either way, it's palpable, and it hasn't felt this stressful. Probably since GFC.
Yeah, I agree. So let's maybe take a quick look at how the news and media headlines are dealing with this. I mean, the overall sentiment, I think, from a lot of what we're reading is there's a glimmer of hope coming now that we're near the end of our rate hike cycle. It seems to be the underlying theme of a lot of news articles that we're seeing now. We'll see if that happens in the States. I think they maybe have got a little bit more to go, but we'll see. And we're still seeing that the other big theme here is we're still seeing that standoff between sellers and buyers, and who is going to break that deadlock first, right? Or are sellers going to ride this right through the bottom and back out the other side? Or do you think that they're going to start selling here before the bottom, and we're going to start to see more market action, and then it'll bottom out and come back? We'll see. So CTV has come out and recently reported they had a conversation with the CMHC deputy economist, and he came out and said that home prices are falling, but likely won't fall much further thanks to housing shortages. Dan, I mean, we've been talking about inventory as a huge problem for some time. He's been quoted as saying, "We've seen quite a large price decline, but there's such a shortage of new construction of new houses in Canada that this inexorable rise in demand is just going to continue into the future. Don't know exactly when it's going to kick back in again, but the shortage in supply means that prices can't go down too much further." So there's some, I mean, based on those comments, Dan, what you're seeing in the ground before I give you my 2 cents, what do you think? Are you seeing similar trends based on what's being reported?
In the sense of people acknowledging that there's low inventory behind the scenes here, and that there's been quite a few alarms actually being raised that, hey, on the other side of this this inflationary issue is, again, the same housing crisis that existed 10 months ago.
Yeah.
And so, yes, I'm obviously very much of the belief of that. And we're seeing it. We feel it. The data certainly supports it. And at the end of the day, I mean, look, our team alone was in scenarios that we think we saw 3 multiple offer properties just in the last 6 days. Yeah. So sure, anecdotal and not a massive number, but we've also seen 11% of all homes sold in January so far sold over the asking price. Yeah. It's not a small number. That means 89 sold at or under. But again, the pressure from that side is definitely building. So I'm definitely going to agree that inventory is extremely tight and will cause an issue on the other side of this. It already is. And yeah, sure, prices are down from peak by a fair amount, but we're still, we're still above pre-pandemic numbers.
Well, yeah, and inventory is, arguably arbitrarily low, even artificially low in many ways, because people were able to get such low rates in the last cycle that they now decided to live in their home for another 5 years where they typically would have sold, right? So that's extended. Then you have developers that are pulling back from developments until they get certainty in what the Bank of Canada is going to do. And lo and behold, we end up with buyers who are more or less frustrated because of this, and it's holding the price floor, which is very interesting. One more press release I want to talk about here. CREA came out here with their 2023 prediction, and also we were lucky enough, I should say, they gave us a 2024 prediction as well, which I don't know how accurate you could be, knowing what we've just gone through in the last year, let alone 2. So anyhow, I'll give it to you because it's interesting. The Canadian Real Estate Association expects home sales to edge down less than 1% and prices fall almost 6% from 2022, which ended with the market in a sluggish state as sellers and buyers sat on the sidelines. So, I mean, the association seems to think that there will be nearly 5,495,000 homes that will change hands in 2023. And this is just based on everything beginning to stabilize. Further, 2024, there's a prediction here, and CREA expects home sales to rise by 10.2% as markets continue to return to normal, while it expects the national average home price to gain 3.5% from 23 to 24, around 685,000, putting it back on par with 2021 numbers.
I love that they put in the 0.2 there. Like you're guessing 24 months out. Like just say 10%. Like
I know.
10.2.
Yeah.
Anyway.
Exactly. Interesting to see if, I mean, and like we've talked about, we find it more difficult to, predict 3 months in advance, let alone 2 years. So there's a lot of things that could impact the outcome of that. I guess it's based on everything remaining the way it is. So I don't know, Dan, what do you think?
I just want to pull up the old MLS HPI prices here for reference, because if you look back to 2008, global financial crisis, peak to trough took 10 months. That was the recent big drop, and it took about 12 months to fully recover. Then 2018, 2019 was a heavy down market. That was 16 months peak to trough. We are now, again, looking at HPI, we've been 8 months in a downward cycle. Yes, it is the fastest falling downward cycle, but that gives you a reference. And for those on YouTube here, I'm going to post a chart, and it really kind of shows that going back to 2005 up to today, there's always a baseline of consistent growth. And then, yes, there's a bit of a peak, and then it falls back, a bit of a peak, falls back, a bit of a peak, falls back. And where prices are today, according to HPI, are very much in line with, let's call it the about 20-year trend. So I think there's a baseline support that we're about to see. And again, we're seeing that with our minimized inventory, keeping prices somewhat stabilized. Again, don't forget, the median and average prices have not really moved since June, July. So we're going to see, and that's continuing, right? We've got the data to the minute here for January, and it's actually ticking up a little bit price-wise compared to last month. Either way, we're seeing not more than, let's say, 1 or 2% move off of the median and average price point dating back to the middle of summer here. So Vancouver's seeing a bit of baseline, a quarter point when it happens. Sure. March, I still have the belief with today's data that they're going to hold rates, and that is going to change sentiment going into a typically busier spring market. So that's what I think is going to happen there. Again, for reference, that's my opinion. It seems like we are nearing the end of the downward price trend in GVRD here.
Now, to be fair, CREA did not say that they expect prices to rise by 10.2%. It was home sales to rise by that amount. So we'll see.
Yeah, bookmark this episode. We'll come back in 22 months here and see how close they were.
Yeah.
Okay, so quick discussion here about OSFI. They are the ones who review and sort of manage mortgage requirements here, and they dictate what happens to the banks here. So they have 2 proposals on the table right now. These are ideas they're putting forth, and this is, again, it may happen, it may not, but it's just funny the timing. Okay, they're looking to tighten credit abilities here for people, and credit qualifying abilities for people in the tightest and slowest market we've seen in 15 years. So it's somewhat reminiscent of like the cooling off period and the foreign buyer ban coming into effect at the slowest market we've seen in multi-decades. But that aside, they have proposed that they might limit the number of high income to loan ratio mortgages. And this is, of course, due to the amount of the highly levered borrowers. And that essentially means the bank will have a cap as to how many mortgages that they can actually issue. So they're going to tend to issue to the people who have the better debt servicing ratios. And number 2, they're looking at increasing the stress test amount for variable rate mortgages. Looking back, I mean, during the peak of the market, it was over 50% of people applied for the variable mortgage because you could technically get a higher dollar figure because your qualifying rate was lower. So people went into where they could afford haha, looking back, in hindsight now, obviously what they're paying today is harder to afford. I mean, if you go out today and you want to apply for a variable rate mortgage, you're being stress tested at about 8%.
Gross.
And they are looking to increase that. So again, we'll see if either or both or none get actually implemented, but this is what they're talking about, again, at a time when very few new mortgage originations are being created, and we're obviously in a very credit tightening environment. And we will see if they do anything with either of these, but it's just, again, I find the timing rather unique that they're just having these type of discussions in this type of landscape. I mean, why could they have not talked about this during the 2 years where prices were ripping at double digits?
Well, okay. So I'm almost I'm in a bit of shock here. If OSFI regulates how many mortgages can be issued by banks, banks by their very nature are only going to choose AAA clients. They're going to reduce as much risk as possible and loan to those who they know they're going to get their money back with. That's discrimination in many ways. I mean, not that they
who gets hurt? First-time home buyers.
That's what I mean. Like, how does this help anyone? This, like the bank should be responsible maybe, I don't know. We've seen it in the past where they haven't been responsible. So I get why they're doing this, but if you handcuff the bank in that respect, then they are going to, by nature, protect themselves. And that's going to hurt people who don't have the credit history they need to get their first mortgage. Why would they give a first mortgage? They would go and give mortgages to people they know who've serviced them before. Like, this is dangerous. This is a dangerous policy.
Guess who it helps? The evil investor.
Yeah.
Right? Because again, they typically have the history and the credit and the cash to be able to afford more. And like you mentioned, it then hurts the people who are struggling just to buy that first home or just make that initial payment, or just get into the market. Yeah. So again, these rules are looking to benefit the wealthier class.
I really like free markets, Dan. This is not free.
True story. Well, those are our thoughts for this week. Hope that helped. Hope you found it engaging. Would love to hear your thoughts on what's happening with both inflation, interest rates, and of course, potential more credit tightening requirements. Thanks as always for watching and listening. Have an awesome day. We'll see you next week.